Okay, so today we're going to talk about developing your own trading style. And for some people, understanding this process is the turning point in their trading because they start to get what it took for other people to be successful. So hopefully you'll understand that some of the things that traders shy away from because they perceive them as being difficult are actually the things that are both essential for your success and actually not that difficult to implement. So that's what we're going to look at today, Eddie.
Fantastic.
Okay, I'll take it away then. Okay, so first of all, why listen to me? I mean, what makes me an authority on this? Because I'm not a trading educator, but I am a trader. And as you know, I also sell trading software. And that sort of puts me in an interesting position because I end up talking to a lot of traders. And that's both professional and retail traders. So it's not unusual for me to be speaking to a market maker, a prop trader, a hedge fund trader, a quant, and a dozen or so retail traders every month. And I also have a chat room where I chat with mostly the same group of traders each day, and I also talk to traders obviously in the top step room as well. And part of the reason I do this is that someone in the industry, I need to keep my finger on the pulse. I need to understand why traders struggle and how our products could help and how changes to our products could help. And I also do it because it's interesting. So I'm quite happy to chat on Skype to a struggling trader. Once they've sent me information on what they do. I mean, I have a lot of people say, I'm not doing very well, what can I do? And that's pretty difficult to help somebody because they're not really telling you what didn't work. So, when somebody tells me, what's worked for them and where they're struggling, I'll have a chat with them. Now, I might point them in the direction of an educator if they're missing a lot of the picture, but often they aren't that far off the mark, so I can make some suggestions. And there's a few traders out that have credited me for their success. But usually what I've suggested is no more than like 5 to 10% of what they do. And they put in the hard work, they just kind of needed a nudge in the right direction. So all I am is someone that's exposed to a wide range of experienced and developing traders, both on the professional and retail side. So I've seen a lot of traders improve, and I've seen a lot of traders self-sabotage themselves over and over again, getting close and then changing direction. I've seen part-time traders transition to full-time, traders or join proprietary trading world, deciding that prop firm is the most sensible choice given their level of funding, places like TopStep as well. But what I haven't seen is two successful traders that trade in exactly the same way. Okay, so they have their own style. And that's not the goal of most aspiring traders. The goal of most traders is to make a profit. Okay, so people new to trading would really like to be given a trading method that will make them money and they just repeat that. So new traders tend to be in awe of anyone that has their own unique style, as if that person did something as revolutionary as curing cancer. As such, they tend to shy away from the very thought of developing their own style. And by having your own style, I just want to be clear, by having your own style, I do very much mean that you get in and out of the market in your own unique way. But what I don't mean is you reinventing the wheel. I don't mean starting from scratch, just staring at a screen and somehow hoping for inspiration. So as I said, I talk to hundreds of traders each year, some of them not profitable and trying to find their way, and some of them making a living trading. Some are trading at home, some are professionals trading at prop shops and hedge funds. Now the successful traders, they're not closed-minded. They aren't at the point where they think they have nothing to learn, but they also aren't at the point where they would be happy to completely change the way they trade. So they have a level of confidence in the things they do, and they really aren't looking to make radical changes. And sure, they'll talk to other traders, and they'll hear about other stuff, but a lot of the time when they're hearing about new techniques, and certainly this is very much a case for me, when somebody tells me about the way they trade and it's radically different from me and they're making a ton of money, I'm not interested. I'm just not. I mean, it's cool, it's nice to know, it's very interesting. I'm not interested in trying it at all. Okay, so in short, they'd welcome additional edge, but not complete restart. So they'll adapt, but they will only take on things that fit within their trading ideology, and that pretty much defines developing your own trading style. It's like an ongoing process. So developing your own trading style isn't something to fear. It's something that traders should actually embrace and expect to happen naturally as part of the learning process. In fact, if traders don't embrace this, they face the prospect of starting at zero again every time they learn a new technique because they think they need to throw away everything else. Now, developing your own trading style doesn't mean you can't get educated. So, of course, you could just try to sit down and figure the markets out on your own, but some of what goes on in the markets is counterintuitive, and certainly figuring it out on your own is a much harder task than developing your own style armed with education. So most traders will need some form of education, and that presents the first challenge to new traders, which is finding useful information. Because if you sat at a web browser every day for the next 5 years, you could quite easily find a different explanation of how to trade every single day. And much of it would be written by people that aren't trading themselves or aren't trading profitably. Now, the main forms of information that people use right now are educators and trading forums. Basically, you Google trading education and you take your chances. Now, the standard for retail trading education was really set by the literary world, and in particular the genre of money-making trading or investing books, many of which go back more than 100 years. Now, trading education did, and mostly still does, focus on technical analysis, and it was typical for a trading book to go chapter after chapter, listing one technical analysis technique after another, or rather one indicator after another, how the indicator is calculated, who invented it, and what it tells you. And the most basic is usually the moving average crossover, and it goes on to more complex ones from there. I'm sure we've all seen books like this. Now, many of these books seem like trading cookbooks with like 25 indicator ingredients that tell you when to enter and exit. Now, that was certainly my first introduction to trading, and I was very happy, as really I am a nerd, to find out that trading was actually all about math and technical stuff. And what never bothered me at all, or rather never crossed my mind, was that one thing was missing. There was never an explanation of why other traders would buy that market at higher prices after I enter the market long, or sell at lower prices after I enter short. Now, unless you want to buy the high of the day, you actually need buyers to buy after you. So who's that going to be and why? And quite often, that question is not answered. So at best, the majority of trading books out there give you something that could possibly form part of your trading plan. Now, of course, it's the books that started this view of trading, and with the evolution of the internet, that whole ideology went supernova. So now we have forums full of people giving each other trading advice, and you have only 1% of them claiming to be losing money when statistics show that 90 or 95% of them really are. The less scrupulous of them build their own education websites, selling educational services and systems that have zero chance of making money. And I'll put my hands up and willingly admit, I spent $15,000 on education that was of no use whatsoever. I did actually spend more than $15,000 on education, but I wasted $15,000 on education. Because it was, and it still is, a totally unregulated industry where a simple disclaimer at the bottom of your site allows you to tell people things that will drain their accounts if they try them in a live market. Now, when I started out in the 2000s, I read one book from a company or educator that was very popular at the time, and it gave a bunch of technical strategies, reasonably complex ones, and quite openly said that these strategies worked and were complete. So I actually went through and coded and backtested each one of those strategies, and not a single one came close to working. Yet this book was one of the most popular trading books at the time. In fact, I saw on Amazon a couple of weeks ago, as I was getting ready for this webinar actually, there's actually a new edition of this book out. Now, on one UK trading forum at the time, people were raving about this book, but it was all hype. No one wanted to admit they weren't making any money. But the book was being good reviews by long-standing forum members, so everybody wanted to join that crowd and say how good it was, kind of getting in with the crowd. The fact that strategies could easily be demonstrated to not work didn't seem to bother anybody. Now, if you did mention that, the fact it didn't work, you'd have like 300 people ganging up on you, calling you a hater. And these were 100% mechanical strategies that could be shown not to work at all, and people would say, no, they just don't work for you. Now, what many traders at the time were doing was combining these indicators in an attempt to produce a working system. So taking multiple indicators that would not work in backtesting and combining them in the hope of producing a winning system. So they might take one system from one book and add in another system from another book and look for something they call confluence for both of them to say the same thing at the same time, basically hoping that multiple wrongs would make a right. Okay, now at this point in time, I've read like literally hundreds of trading books. Mostly when I was new to trading, very rare for me to do it now. And I can think of only a handful that have merit. I like the interview books are okay, but they're not really my thing. But like in terms of the way the market works, Pablo Triana, Nassim Taleb do an excellent job of explaining the probability and the danger of too many people relying on the same mathematical models. Gary Norden does a good job of explaining how institutional trading works. But in terms of actually giving a full trading strategy from end to end, there's lots of books that claim to do this, but I have yet to see a single one that does, or meet a trader that say they learnt to trade profitably that way. And like I said, it's a completely unregulated market. Now, it's 2015, and I think the marketplace has become a lot more savvy than in the 2000s when I started out. So people have woken up a bit, and there is now more information around about how professional traders operate. Now, for a long time, it was believed that professional traders had secrets, and of course many educators to this day use secrets of the pros in their promotional material. Now, I know a lot of professional traders, and they are generally quite open about what they do. And what they do is often quite simple, but it has no relationship to what most trading books discuss. And there is no secret cabal swearing secrecy of their techniques either. It's just that these people don't hang out on trading forums because there's no need for them to do that, and they don't really looking for that. They're not looking for how to trade on the internet. Now, one trader I know retired at 35 years old. He was plucked from Oxford University in the UK, and he spent his very short career in a bank in Singapore, heading a currency team, doing stuff like writing barrier options. Now, we were having a chat about what he did, and the topic somehow came around to retail trading. And I asked him what he knew about retail trading, and I mentioned MACD, stochastics, Fibonacci's, and he just gave me a completely blank look. Never heard of any of it. Yet this guy had fully retired in his early 30s. Now, what he did know about was risk, and he was obviously very good at math, and that's why he got plucked from Oxford University, and that's why he ended up in the options, the Forex options world. But again, he had no secrets. Okay. Now, we have another friend that right now runs an open outcry currency desk, which basically means facilitating trading of a single currency pair. Now, he has banks on both sides of the pair, and it's not like Euro USD, it's an exotic pair. Hence the need for the open outcry. So he's got banks on both sides of the pair, and his job is to put them together. And he drives a $150,000 car. He's doing very well. He doesn't even look at a chart. Now, on a busy day, $1 billion will go through his desk. And if you're friendly and interested, he'll invite you to work the next day to watch him in action. And if the market's active, he'll facilitate trade. And if it's not active, well, he kind of just convinces his audience that there's more interest than there actually is to entice him to trade. So his great skill, he's just really good at talking, and he can get the market going when there's no interest. Now, both of these guys are absolutely accomplished traders, but could either of them intraday trade crude oil or the mini S&P 500? Not a chance. They just wouldn't have a clue where to begin. So it's just two examples. So they're both professionals, but neither of them are doing something we could replicate at home, and neither are doing anything that we could really consider to be a secret. Okay, so we couldn't put two banks together at home and put $1 billion through our desk at home. It's just not possible, right? So when people talk about the pros, and you're looking to place a directional trade, buying to sell higher or selling to buy lower, remember there's a lot of professional traders that aren't even playing that game. Now, prop traders, on the other hand, are more like us retail traders, because many of them are trading spreads, but there's quite a few taking outright directional trades. Now, some prop shops focus on something I'd call situational trading, such as trading stocks on news or earning announcements. So effectively trading certain scenarios rather than the same stocks over and over again. Now, prop shops that focus on futures tend to have their traders trading very short term initially. In many cases, they're only allowed to use charts once they actually become profitable. But there's no secrecy. But the fact is, your average prop trader doesn't have a website and a marketing team, unlike those who generate their income educating traders. So prop traders don't sell books on Amazon.com either. So it's not that these guys won't talk to you. It's just that there's a whole educational industry out there all vying for your attention, and the prop guys, they just go to work and trade each day. They just aren't as visible. It doesn't mean they're hiding. It doesn't mean they're keeping secrets. And anyway, as the market has got more savvy, so have those who want to take your money in return for something of absolutely no value. So in the 2000s, we had people selling magic indicators to tell you when to buy and sell. And in 2015, we have magic indicators telling you where HFTs are going to go buy and sell. So HFT has become the latest in a long line of reasons you aren't making money trading. And many companies are exploiting that by telling you that they have the secret HFT knowledge that you need to make it. So when looking for education, a really good rule of thumb initially is stay completely away from anything that claims to be letting you in on a big secret. Anyway, back to the educators. One of the claims that many trading educators make is to be able to teach you a single system for all instruments in all time frames. And this is something we really have to look at, because it's a belief that needs a lot of consideration. Because if this is your goal, or if it's something you are relying on as part of your trading method, you need to consider it very carefully. So first, let's consider the time frames. So when they say all time frames, they're obviously referring to time frames on a chart. So the idea is that the method could equally be applied to a weekly, daily, 60-minute or 5-minute chart. And that does, of course, rely on a huge assumption. That is that the market moves in time frames in the first place, that there is merit in dissecting the market action to different chunks of time and assigning meaning to the open, high, low, close of those chunks of time, or applying indicators to those chunks of time. Now, of course, I am playing devil's advocate here because I do use charts myself, although I don't pay attention to individual bars or candlesticks. So we can agree that charts have merit, but does that mean you can apply the same system to any time frame and it's going to give you profitable trades regardless of that time frame? Now, I'm not telling you not to look at a chart here, but I am asking you to consider the merits of splicing the day into intervals and assigning meaning to what happens on each bar and each interval, or placing a system on top and expecting it to work regardless of the market or interval chosen. Because at the point you do that, it is literally 100% math and 0% market understanding. So let's agree that charts have a place, but let's consider this all time frame theory by considering a group of greedy, money-grabbing, good-for-nothing people, day traders like myself. Now let's consider the E-mini S&P 500 futures. Here it is. Now most days, this market is dominated by day traders. You will see days where we swing up 12 points, down 15 points, back up 10 points before ending pretty much where we started. And the reason for that's simple. It's a normal day. There's no real long-term repositioning going on. And we can have 1.5 million contracts trade and go absolutely nowhere. So the day traders all got in and out by the end of the day because that's what they do. And on most days, those guys are the majority. And each day is different. We have non-farm payroll days, which can be wild in the morning after the announcement. We have FOMC days, which tend to be really slow morning before the afternoon announcement. We have the summertime chop, a seemingly endless period of day after day of slow range-bound action. And as the day ends, we get very specific action. So in the last 15 minutes, as people unwind, we get very, very specific action. You get thousands and thousands and thousands of contracts trading all at a couple of prices with no movement and no sign of people like getting stopped out either side. We have a slowdown at lunchtime. We have it speeding up in the morning. On some days, we have a major news event. Recent events in Greece and Ukraine hit the market sideways with unexpected intraday news. Other days, the news events scheduled. We're out of line of expectations, and then major repositioning does occur and day traders aren't dominant as the larger institutional traders come in. So there's certain intraday activity that has very specific characteristics, and the day develops influence by both the day develops influence by both the calendar and by an unwritten but well-known intraday timetable. So on this market, the majority of trading is speculation, which is just nothing more than a polite word for gambling. So most it's short-term players all trying to make money off each other. And the amount of speculation varies market to market, and it is important to understand how much of the trade on your market is purely short-term gambling. So this suggestion that an indicator or a chart pattern or some sort of generic system will somehow be able to get you in and out profitably on this market without considering any of those things I've just discussed, it's very, very appealing, but it's not very realistic. It's basically saying, just forget all that stuff. Forget the FOMC, forget NFP, forget the end of the day. None of that's relevant. Saying the factor market behaves a certain way between 9:30 a.m. and 4:15 p.m. because short-term speculative trading, it's just irrelevant when it comes to applying this trading strategy and beating all those traders at their own game. Because I can assure you that applying a generic cookie cutter system to the market is not what all the 100-lot traders are doing in the market, okay? So the chances of you beating them at their own game with a dumbed-down generic system are effectively zero. Now, worse than this, there are people that will tell you not only can you forget all of that stuff, you can actually just take random trades and money manage your way to profits. And this all started because there's one famous book that details an experiment to prove that money management could make a bad system good. And what they did, they entered the market at random and they applied a trailing stop and they made money over a period, I think the period was like 10 years or 12 years. So now, not only can we make money regardless of the time frame, we can even make money if we have no clue where the market's going. You can like literally just toss a coin and let money management do the rest. Now, it was an interesting experiment, but what they really developed was a trend following system. In an uptrend, a coin toss against the trend would stop them out really quickly. But a coin toss with the trend would see them ride the trend with the trailing stop. And the markets they chose were trending over the test period. Had those markets been choppy, they would have incurred massive losses. Now, the other thing to think about, would HFT companies with the massive infrastructure cost, would they even exist if you could just toss a coin and still beat other traders at their game? Now, before I go off on a total rant about all time frames types of systems, let's consider the other side of it, all instruments. As you can probably see that like the intraday thing makes all time frames problematic, but it probably sounds more believable for a system to work in all markets. Now, we're trading electronically, but that doesn't mean there's always an endless supply of stuff for us to buy and sell. So with futures markets, there is infinite supply. Futures contracts get created and destroyed in the course of trading. So when people agree to transact, a contract may be created. So there's no end of contracts. You can trade in any direction, anytime, and you will find somebody on the other side of your trade to trade with. Now, that's often a market maker, and it's often not at the greatest price. But you can rely on them being there 99% of the time, except in really extreme conditions, where they do tend to do a bit of a disappearing act. Now, if you look at stocks, it's a little bit different. There is finite supply called the float. So a certain amount of shares are issued, and they can't get created as trading occurs. You can only buy what's available. So unlike futures markets, if you want to go short, you need to borrow stocks from somebody. And smaller brokerages might not have any to short. There can be squeezes when there are so many people short that the effective float is low and there's a scarcity of contracts to buy. And that causes prices to rise really rapidly when the outlook becomes more rosy and people do start buying, and then the shorts get squeezed out because they have to buy as well. So sometimes you want to short, but you can't because there's no shares to borrow. Now, is that irrelevant in trading? Is it, again, more useless information we can ignore because a candlestick's a candlestick? Now, with Forex, it's not so much availability that's an issue, but the fact you aren't actually trading the market in the first place. Because we have broker markets and we have dealer markets. And with a broker market, like stocks, options, futures, you place an order through a broker and they put that to an exchange where you are matched with somebody wanting to trade on the opposite side. With dealer markets, like retail cash Forex brokers and markets like spread betting in the UK, there is no exchange. The dealer does nothing with your order. The dealer effectively takes the other side of your trade. Now, with one dealer in the UK, I'm not going to mention the name, they basically take a maximum risk of $15,000 on any one individual market. And at that point, they have to start laying off that risk hedging that risk on the real markets. So effectively, they'll take $15,000 of the other side of your trade, knowing that most people lose. Okay. Now this, when they do come to hedge, they actually have humans, they actually have traders there to do that hedging. It means it requires human intervention. So if your order's the one that pushes them past the $15,000 mark, or if your order carries that much risk on its own, you're going to find you don't get filled so quickly because there's actually a human being that needs to do something. And you might get requoted as the dealer reduces their risk by doing stuff like widening their spread. Okay. The different markets also react to different events. So interest rate products react to treasury auctions, but you'd be hard pushed to see any indication that it had impacted crude oil. Crude oil reacts to the oil inventory numbers, but it barely registers on the indices. Weather's going to affect the grains. Disease will affect the meats. We've heard from Wally about that many times. So if you decided to apply your catch-all system to corn futures, for instance, and you had no idea of the news events, the scheduled and unscheduled ones that could cause a sudden spike in corn prices, you will eventually get into trouble with your all market system. Now, I'm not suggesting here that you need to know all the minutiae of every market, every type of market and instrument. I'm just suggesting that the all time frames, all markets technique simply doesn't exist for these reasons and probably many more. So what I'm suggesting is that to progress, you may need to focus on a single market or situation, or maybe 2 or 3 at first. Personally, I think 1 is enough for most traders. So you need to get to know that as opposed to getting to know trading as a generic topic. So if you find a technique that works for you intraday on US Treasuries, the chances of that technique working without change on crude oil are extremely low, but the chance of it working on like the Euro Stoxx 50 futures, that's pretty decent, even though it's not even an interest rate product, it's an index future, but mostly because they're similar in terms of liquidity. So education of the generic variety will not give you a complete system or a complete trading method, but there still might be something of value in a generic course. Okay, so my suggestion, instead of being led around by the nose, getting pulled into the latest sales pitch you saw in your inbox, you need to actually take control of your trading education. If you don't, it's going to be a very expensive process because you're going to fall victim to a lot of unscrupulous vendors. So you need to actually have your own curriculum in mind, your own set of absolute requirements for any trading education you undertake. Now don't panic, that's not as tough as it might appear. We're going to go through this. You just have to have in mind what you're looking for, and no matter how strong the sales pitch, you just ignore what doesn't fit. So let me give you a rundown on how I think you should approach your trading education. So your first requirement is the why has to come before the how. Okay, so what is it that makes people buy and sell? Now there are many theoretical frameworks that explain this. Okay, it's kind of your doctrine, your market doctrine is what you need. Okay, now I personally believe in value-based concepts, that markets balance around a fair price and then find another fair price, balance again, and so on. And I'm also a very firm believer that speculation drives markets, okay? And I don't mind using the word gambling because that's what speculation is. And that most market activity is pure speculation. Now this doesn't mean I'm always right. It just means I have a reason for getting into a trade and a point at which I can say I'm wrong. Now some people believe in Fibonacci, for example. And that's not something I get conceptually or that I have faith in, okay? So it follows that I couldn't confidently trade using Fibonacci levels. It's simply not for me. It doesn't mean it doesn't work. It just means it's not for me. So it's entirely possible that having this strong belief in your market philosophy, your market theory, your market doctrine, and the consistency in trading behavior that results is more important than the details of the philosophy itself. Now consideration has to be given to the other players and their trading horizon in your chosen market. So do the ups and downs in index futures we see, from one week to the next, really represent daily schizophrenic mood shifts in major long-term institutional players? Because I don't believe they do. I mean, do we think those people that are managing billion-dollar equity funds are waking up in a cold sweat one morning, selling their positions, only to wake up the next day and think, oh, it's actually not so bad, and buy all their positions back? Or are those ups and downs the result of mostly short-term speculation? Well, you know what I believe, right? My belief is that on most days, the main driver of the market is that short-term speculation. Now, of course, there are days when major institutional repositioning is occurring, and that's fairly evident by a major increase in volume. So if short-term speculation drives the market most of the time, then intraday opportunity will come from short-term speculators jumping on a move or getting caught offside. Now, if the players are all long-term in a market, that simply won't be the case. They won't react to smaller intraday moves. Now, new traders always want to know, the first question they ask, where do I get in and where do I get out? They want to learn a setup, okay? And there's lots of unscrupulous people out there more than willing to sell them one. But that's not learning how to trade. It isn't learning about how a market works, why it moves in a certain way, and then trying to exploit it with a setup. The next requirement of any trading education is for you to believe. Now, of course, that needs your market theory in order to be able to believe in it. But in order to enter and manage trades consistently, you need to believe in what you're doing. Okay? You need a firm conviction that when you buy, other people are going to buy after you. You need a firm conviction that you'll exit your trade when you know your trade is not working. So no holding and hoping just in case. So you need to be able to stay the course and not give up because of a bad run. And if you don't believe in what you've been taught and that it fits in with this market theory, you will not stay the course. Okay? So most retail traders start looking for this setup, a set of mechanical rules that tell them when to get in and when to get out. And they've got little concern over why other traders would buy after they did or sell after they did. And when it goes wrong, the setup is to blame. So after a run of losses, confidence is shot and the traders short on solution because they can't fix the setup because they've got no idea why the setup might have worked in the first place. So it's simply not possible to develop as a trader under those conditions. So when things are working for you for a while and they start to deteriorate, and I can guarantee you they will, without doubt, you need to be able to stay the course and you need to be able to look for reasons that fit within your market theory and see if the reason for entering is still valid and to look at what's changed. Has something changed? Okay. Now your next requirement is the opposite, is to not believe. Okay. Now believing means having faith in what you're being taught, but it doesn't mean believing claims that you want to believe. Okay. So let's say you've got a choice of two teachers. You've got one guy who tells you he's chipping away at the market and making 8 ticks a day on the S&P 500 with a rational approach and a valid reason for getting into trades. You've got another guy sending you pictures of him next to a blonde and a Ferrari telling you can make $1 million from your $200 account in 3 weeks if you buy his $10,000 indicators. Now you may feel inclined to believe the second guy because the second guy is just telling you what you want to hear, that you can make money quickly, easily, with no fuss, and most importantly, without engaging your brain. And there are more trainer 2s than trainer 1s in this world, and lots of people fall for their hype. I fell for it to the tune of $15,000. In fact, in many cases, the moment you ask these guys questions, their ego kicks in, and they say, how dare you question me, I'm great. And for many people, they get impressed by that show of ego, and in the face of all rational thinking, they go ahead and buy the product. And it's okay to do that once. It's okay to do it twice, but please don't keep repeating it. Now the next requirement for your education, and a vital important piece of your doctrine or your market theory, is whether or not you believe trading is a skill. Because if trading is a skill, then regardless of the method you'll learn, you're going to suck when you start out. Okay, so let's take another example. Let's say you wanted to become an Olympic athlete. Dad, I want to be in the Olympics. So what you do, you try javelin for a few weeks. You see you're not much good at it, so you try pole vault for a few weeks. Decide that's not for you, and you give the hurdles a go and so on. That's kind of crazy, right? But that's what lots of traders do. They learn a technique, try it for a week, decide it doesn't work, move on. So if the method fits in with your trading doctrine that you believe in, you will work through your weaknesses to improve your skill. But if you don't trust that doctrine, if you don't trust the theory on which it's based, you're going to have nagging doubts and you'll give up. Okay? So those that think trading isn't a skill tend to gravitate towards mechanical setups because they believe that when somebody reveals a secret setup, they'll be able to make money with it forever. So they won't treat the method as a skill, and they will discard it after a short period because it doesn't work for them. There's some traders spend years in this cycle of trial and error, always thinking their problem is that they just didn't find the right setup yet. And there's that commonly held belief that the pros know trading secrets that retail traders don't. And if there is a secret that the professionals know that retail traders generally don't, it is simply that trading is a skill. So if you go to a bricks and mortar prop shop and do an internship, they're going to have you sitting there doing the same drills over and over and over again, so you develop the skills you need to read the markets. And those interns are told not to deviate. They're not allowed to switch styles every few days. They have to sit down and grind it out. So a good training program is the fastest way to get on track, but any program must give you a rational theoretical foundation for what the market is, who is playing it, and why. And it has to tell you when conditions are good for trading and when you should stand aside. Now, this doesn't all have to come from one place. It doesn't all need to be tackled in one go either. But your market theory must come before you start to look at when to enter and exit the market. Because so equipped, you'll soon be creating your own niche in the market without trying to copy somebody else's. Now, as an educator, if they really are traders, and if trading is a skill, no educator can tell you everything they do. It's impossible. Okay? If you want to trade like them, exactly like them, you would literally need to sit down with them for months and probably end up annoying them a lot in the process with lots of questions. Because even if they answered all the questions you asked, there would seem like there's so much information, so much nuance, that you'd have 1,000 rules going around in your head. So for example, your mentor might say, well, there's a long entry there, but it's a Monday after NFP, and it's usually pretty quiet then, so I'm waiting to see a bit more participation. And then you say, whoa, more participation? Well, how much volume would constitute more participation on this market? What's the exact number I need to see trade? And at that point, the guy would look at you sideways and say, there is no number. It's just a matter of experience. And many people want to replace that experience with absolute numbers. They don't want to hear that somebody watches this market every day, and when a lot of traders come in, they can see it. There's a lot of traders. No, they want an absolute number of traders written down. So 15,436 is a lot, and 15,420 isn't a lot. And they might even want to put that on a little post-it note on their wall with that number written on it. Because an educator can't teach you experience. And if you believe trading is a skill, the best they can do is teach you the basics so that you can develop the skill yourself. Okay? So you just have to put up with the fact that it's nuanced, and that nuance will come to you over time, and it's just really difficult. If you're putting together a course and you've got all this nuance going around in your head, and you're the educator and you're a good trader, you're not going to remember every small nuance of what you do. And if it's someone that trades in, day out, they're going to be doing some things on autopilot that might not even realize that those things are part of their decision-making process. Now, I know a trader that runs a quant firm, and this firm leases software to banks, and it places long-term arbitrage trades on currencies. So this guy would definitely be considered quite smart. And he's also a fairly large day trader. And he once attempted to automate his day trading, and he just couldn't get it working. So he started off, he gave his developer the rules, and he got the system back. Oh, dumbass, doesn't work. And then he realized he'd missed some nuance, so they coded in more rules. Didn't work. And that process of trying to redo it, more nuance, redo it, carried on until you just realized it was literally a fruitless exercise because of the amount of nuance and experience in the way he traded. And this guy was a quant. This guy has automated long-term arbitrage systems running at banks, okay? But when it comes to intraday trading outright positions, that is a different matter entirely, right? So this nuance isn't bad. It's not complex. It's not actually a massive list of rules. It's just reading the market, weighing it up and thinking, man, that doesn't look good today. And it's not that dissimilar to looking outside and thinking, oh man, it looks like it's going to rain. Okay? It's an experience thing, and you can't teach experience. And also, there's another thing an educator can't do for you. They can't guarantee you will like what they are teaching. Which brings us to another very important aspect of developing your own style, your personality. Now, from time to time on the trading forums, this topic comes up. And it always amuses me, and the topic is, what's the best personality for a successful trader? And it's an odd question, really. I mean, it's not as if you can change your personality if you find you're not the right type. But my experience is that there simply isn't one. So I know a trader who trades a massive account, okay, tens of millions of dollars, okay. He's very successful, but he's also most likely bipolar. In short, he gets angry and he flips out a lot. He rants and raves at his researchers. Now, on the other end of the spectrum, I know a successful trader who trades like he's painting a fence. He's totally calm, never gets ruffled. Now, in both cases, I believe that their personality dictates the kind of trading that they do. So the first guy has pretty wild swings. He can be up 100,000 one day, and he can be down 30,000 the next. And on any day, he can be in 30 intraday positions at any one time. Okay. Now the other guy sits on one market, waits for conditions to be right, and then just hits into it. Often just taking one trade a day. Okay, he takes big trades, but just one trade a day. So my own belief, based on myself and discussion with other traders, is a huge factor in trading and the trading style that suits you is your boredom threshold. Now I have a hard time watching a slow market like the US Treasuries or the Euro Stoxx 50 futures. I can watch it for about 5 to 10 minutes, but then my mind wanders and I zone out. And I mean quite literally, even my eyes lose focus. I just find myself just in a daydream, okay? Now, on the other hand, I'm not comfortable with faster markets like crude oil either. So I like a certain amount of activity, but I don't like it too fast. Now, at the extreme here, I know a girl that trades a really, really, really thick interest rate product. Now, she gets into the queue with an order, okay? There might be 4,000 people in front of her in the queue. And as she gets closer to the front of the queue, she will cancel or keep her order depending on how many people are now behind her in the overall conditions. So she's literally watching a market for hours, right, where price isn't moving. It's just sitting there trading the same price for 10, 20, 30, 40, 50 minutes. And that's where she trades. Gets to the front of the queue, decides whether she should take it or not. It would kill me. I would struggle with that. But it's a valid way to trade, right? So the first part of developing your own style is understanding what you can tolerate in terms of downtime, that time not trading. So if you're an adrenaline junkie and you spend your spare time doing naked bungee jumps, then spread trading treasuries is not going to be for you. If you're the type who's always doing multiple things at once, you might want to focus on multi-market strategies like day trading earnings stocks. Because there's no point in spending time learning a skill that you could not tolerate repeating day in, day out. And there's also no point in trying to change your personality to suit a particular style, because you are who you are. And, this is something I have to tell my wife on an almost daily basis. I can't change my personality. Now, you might contact an educator and say, okay, with this system, how many trades would I get in a day? And they'll say, oh, that's irrelevant, or that's the talk of an overtrader. You can only take what's there. But if you're an action junkie and you're scalping crude for 3 ticks at a time, then of course your trade frequency is going to be higher than if you're fading ranges on US Treasuries. So remember, these guys want you to buy their calls. And this is not a dumb question. How many trades will I get? But they're going to try and make you feel dumb by telling you that's a stupid question. Because the fact is, they want to avoid answering that question because they don't want to say anything to put you off their course. Okay? And this is probably a good way to deselect an educator. But remember, if they keep showing you the pictures of the blonde and the Ferrari, and that's what's making you like them, you're going in for the wrong reasons. Now, I was chatting with a trader the other day, and he said something that was very obvious to me, and he's like, oh, this order flow stuff? It seems that when I'm really sure of a move, it's already on the way. And it's like, yeah, bingo. And of course, there's exceptions to this. All trades are different, but sometimes you get a really good reason to enter a trade at a really good price, but generally speaking, confirmation is going to cost you ticks or pips if you're a Forex trader. So in other words, the more confirmation, the worse the entry price. So this trader wasn't entering until he was 100% sure, and that 100% sure was when the move was already underway. So he needs to incorporate a little bit more unsure into his trading, because trading is a game of uncertainty. And the best traders, they'll see something, they'll get in, and they'll get out quickly if they're wrong. Okay? And they'll accept something that's very important in trading, right? When you get out of a trade, when you think you're wrong, after you get out, it's going to go up or down. So a lot of the times when you get out of a trade because you think you're wrong, it will go your way. And that doesn't mean you got out at the wrong time. Okay? So when I meet a trader that's put in 5 or 10 years of study and is yet to be profitable, I tell him simply the following, okay? That there's traders out there right now that know much less than you about trading but are making money most days. In other words, more knowledge or more study is most likely not what you need. It's the acceptance of less certainty, okay? Because many traders are seeking certainty. They learn a technique, it doesn't give them that certainty straight away, so they don't get better at it and they move on. It's that whole skill argument again, right? But there are trading methods where the probability is higher than others. So I know a trader and his stats are 85% wins, 5% loses, and 10% scratches. And his average time in trade is less than 30 seconds. So once again, different styles of trading will offer different trades with varying degrees of probability as you improve, not straight away. So you should look to match the style of trading to what you personally will suit you best, okay? Now, once again, a legitimate educator should be able to have an open discussion with you on this topic and not just shut you down because that's a stupid question, because this is not a stupid question. Anyone that tries to shut you down when you ask questions like this, like about the win rate, potential win rate, does not have your best interests at heart. Because obviously, win rate will depend on how good you end up being, but it's also going to depend on the style you're applying. Okay? So some methods are high win rate, but the winners are smaller than the losers. Some methods are lower win rate with a lot of scratches and an attempt to gain a larger trade. Nothing wrong with either of them, but you have to know yourself and what you can tolerate in terms of losses and certainty, and also how well you get out of the way when it runs against you. And for many traders, when they start out, it's something you simply won't know yet. So for some of this, with the whole uncertainty thing and frequency and trade frequency and win rate, potential win rate, you're just going to have to grin and bear it and maybe find out the hard way and learn some things that are valid but maybe aren't for you, okay? Which kind of brings us on to the major topic, which is developing your own style, okay? Because for very new traders, it's going to be hard to know which sort of markets and techniques you will find suit you more, okay? It's difficult. If you haven't done any trading, it's really difficult. Do you want to hit a high win rate or a low win rate? Very, very difficult to know from the off, okay? Now, we've already said you can't change your personality. We've looked at the fact that you can focus on what suits you. And we also said that developing your own style will happen whether you like it or not. So how does that actually occur? Well, partly it's because of what you like, and partly it's because of what comes easy to you and what fits in with your beliefs. So I'll give you some examples. I once read a book on trading the ES. Okay, what was in the book didn't resonate with me. Okay, but I didn't really buy what it was telling me basically. I didn't really believe what it was saying. But one of the things mentioned in the book was a way to tame the NYSE tick, which is something that basically helps us to see the ratio of stocks on the New York Stock Exchange that are moving up versus moving down. And here is the NYSE tick. Now, if you trade index futures, then of course it helps to know what the stock market is doing because the index futures are a derivative of the stock market. So I ended up following their suggestion on how to make the tick more readable. I did that, and I kept my eye on it day in, day out. So here's the NYSE tick at the top, and at the bottom is the tamed version. Okay, so maybe looking at this, the difference isn't huge, but for a quick eyeball view, it's really a lot nicer. So I didn't really change the way I traded at that point. It was just another correlated market for me to watch alongside the Dow and the Nasdaq. Now, I already believed that correlated markets were essential to day trading. And over time, I found this tamed tick be a fantastic addition to my analysis. So, but the funny thing is, I'm one of these guys, I find it hard to believe in indicators. And to get this tamed tick, I had to write an indicator. But I felt it fit in more with my beliefs than against, so I was able to believe. So now my trading style uses an average of the NYSE tick, and I don't know many traders that use it. The only traders I know that are doing so because I told them about it. But still, I don't feel that incorporating this into my style was a great achievement. But the keys where I believed it might have been of use, I was actually able to read it, and I saw value on execution. So adding this into what I already do makes my method of trading more unique, more my own, it's my own style, but I'm no Einstein. Now, another example, I took a course by John Grady, who teaches order flow and trades US Treasuries based on the Dome. I got his ebooks, videos, took his course, but John trades US Treasuries. And when I look at US Treasuries, like I say, they move so slowly, my eyes just glaze over as I'm watching them. I can't focus. There's not enough movement on there to keep my brain interested. Like I said, go to crude oil, I've got the opposite issue. It moves so fast I can barely keep up. But on the index futures, the pace is about right for me personally. So in that case, I had the belief, but there was something about certain markets, so the markets that John used, that just didn't gel with me. So I took the techniques that John taught me, and I applied them to the ES. And I had to make a few adjustments. But again, it was making what I do just a little more unique. Now, so far, there's been nothing here that qualifies me as a genius. I can't keep falling asleep at my trading desk so I can't watch the treasuries, and other people love them, but it's just not for me. And I can't see the point in trying to force myself to do something I can't focus on. So the sensible thing to do is find a market with the right level of action for me. And as I mentioned earlier, perhaps it's just my boredom threshold. I mean, I know a trader that gets bored. I mean, this guy gets bored very easy and always has to be in a trade. And he's found a way to to manage that. And I know traders that can quite happily sit a whole session without taking a trade. And I'm one of them. I can literally sit a whole session and not trade. So you can either attempt to change your boredom threshold, or you can look for techniques that play to that as a strength. If you're very laid back, stay away from crude. If you spend your weekends doing parachute jumps, then stay away from treasuries. So as you go, and as you learn new things, you examine them, and you need to ask yourself a few key questions. So the first, as you come across something new, first thing you need to ask, does this fit in with what I already believe? My theoretical framework, my trading doctrine, and what makes people buy and sell? If not, do I feel strongly enough in this to change my beliefs? If it does fit in, can I actually incorporate it into my trading? And if I do incorporate it, how do I track that the impact is not negative or ensure it's not negative? And if I incorporate it, how long do I expect to get through the learning curve so I can actually benefit? And which parts do I want to incorporate? Are the parts some good bits and some bad bits? Are there certain parts I find hard to believe? Are there parts I just don't like? I mean, if you don't like something, don't do it in trading. Trust me. You won't enjoy it, right? It just won't be successful. Okay, so if you're not comfortable, you don't like it, it's just not for you. Because there's lots of ways to make money. There's spread trading, outrights, market making. As an outright trader looking to take intraday trades that last hours potentially, spread entry techniques might not help, but market making techniques might help to refine your entries. And certainly they will help to understand who's on the other side of your trade sometimes. So do learn about the way other people operate. Now you can't keep changing the way you trade because that's what leads to disaster, and I'm sure there's people here that do that. But as the market changes, as it does each summertime, you do need to adjust. And that adjustment might be something your current level of knowledge doesn't accommodate. Okay, so there's going to be index futures here trading their first summertime and now wondering what the hell happened. Okay, so as the market changes, you might need to adjust, and that adjustment may well mean learning new techniques. But at that point, you should know what works for you and know what your requirements are for any new techniques you need to learn. So as an intraday trader that benefits from intraday trends, you may want to switch to range trading, but you might not have the techniques down. So you would need to adapt, and that might involve finding somebody that can help you to adapt to that market. Then, of course, as you're observing the markets and as you understand how they work, you're going to see things occur on your own. Now, I have a free order flow course on my website, and I talk to a lot of aspiring traders on how to adopt order flow. And in most cases, what I do is I tell them to look for just a few things and then come back to me and tell me what they see, and we take it from there. And every now and again, a few months will pass, and I'll get an email from a trader saying they've seen something that seems to occur often, and they'll explain it to me and ask me, well, what do you think about that, Pete? You know, what would you do in that situation? And quite often, it's something they've observed, but has just never occurred to me, or I've just never noticed it. And if it makes sense, there's really no advice I can give. But it's just the guy or girl has a confidence issue. They already know what they need to do. If they see something happening over and over and again, it's an opportunity. They know what they need to do. They just need somebody to like take it to the next, to tell them take it to the next level and figure out how to trade it. So this developing your own style, it's a natural process where you develop as a trader, have a theoretical framework which you truly believe, learn things about trading from legitimate sources, and adopt what fits your personality and your theoretical framework. And you adjust as the markets change, the markets change gears. And also part of the process is making sure you're actually tracking your progress somehow. And in fact, if you think about it, it's hard to see really. I mean, I really believe this, hand on heart, believe it's almost impossible to not develop your own trading style. Okay? So we've already mentioned that no educator can teach you experience or be expected to have every nuance included in their course material. So some of it's got to come from you anyway. But there are some common elements used by successful traders, the traders I talk to. So we'd like to say we've got many ways to trade the market, but there's some things that just come up over and over again with successful traders. So as you develop your style, keep these things in mind. All successful traders treat trading as a skill. And that means they paid a price early on in developing their skills. So I've never ever met a trader that just took to it like a duck to water, but I'm sure they do exist. I've just never met one. And traders never stop developing as traders. And I'm not talking about a new technique every week, but I am talking about always keeping on the lookout for additional edge, as well as being aware of market rule or macroeconomic changes. So keeping up to date with the markets and engaging with fellow traders. Even if that just means having a call with a trader friend every few months, it's really beneficial to share experience. So I tend towards shorter term day trading myself. And so I tend to speak to other shorter term traders, and we'll just have chats every now and again about stuff we've noticed. And quite often we're noticing the same things, the same changes, certain size trades just disappearing, that kind of thing. But sometimes one of the guy will have noticed something the other didn't. And I've found other traders, even professional traders, to be really friendly and helpful in this regard. And at the end of the day, it's good to talk shop about what you do. It's good to talk about trading. Because you know what, when you go out to a party or whatever and you tell people you trade, it's like telling them you're a dustbin man or telling them you're a computer programmer. Their eyes glaze over, man. It's just people don't want to talk about it. Their eyes glaze over when you mention it. And there's lots of industries that have networking events. But trading really is quite solitary. I mean, it's not if you live in Chicago or a major city, but if you're, in a small town, it's a really solitary endeavor. And so you need to do what you can to stay sharp. So you need to be talking to other traders, okay? You need to always be treating it as a skill, and you need to, soccer players talk to other soccer players. You need to be talking to other guys. Now, the other common element, traders use correlated markets. And trading one market in isolation, in my opinion, is giving yourself an unnecessary handicap, because all traders I know use correlated markets. So if you trade the S&P 500 futures, it pays to know what the Dow and Nasdaq are doing. And partly that's because arbitrage keeps related markets in line most of the time, and partly because they activate and become inactive or range bound around the same time. Now, of course, correlations and inverse correlations do break down. There used to be an inverse correlation between the indices and the interest rates, and for a long time it broke down, and there were macroeconomic reasons for that. But watching these correlations, the inverse correlations on a daily basis, it's pretty obvious when a correlation has broken temporarily. So correlations like the S&P 500 and Nasdaq tend to break down only on the occasional day, okay? And they can go in the different directions all day. So relations like the indices and treasuries can break down for extended periods. But quite often there will be a clear leader on a day, which is a definite edge, but a lot of the time it's what the correlated market isn't doing that's important. So if you trade the slowest of the indices, the S&P 500, and you want to go long, it's best not to do that if the Dow and Nasdaq are tanking, if they're moving down. But similarly, when you're in a trade, you want to watch those other markets to make sure they're not moving against you. Now, watching a less volatile market for confirmation is slightly different. So I trade the ES, which is slow, and I watch more volatile markets. If you're doing it the other way around, it's a little bit different, because if you're trading let's say you're trading the Dow, long watching the ES for confirmation, you really want to just see not more, you're not going to see much more than more contracts hitting the offer side on the ES and the bid side. So you'd not necessarily be looking for the ES to be moving up. You'd kind of be looking at, more local information, like bid and offer information. But certainly, I think if you're trading a thicker market, it's a lot easier to use correlated markets watching a thinner one. Now, the other thing that most traders I meet use is something called value. Okay? And by value, I don't mean Jim Dalton market profile. Okay? That is one way to assess value. Okay? So let's think about what does value mean. It's a very simple concept. Okay? So let's say you came from Planet Zog and you don't know the price of anything, but apparently the Zog dollars just coincidentally look exactly like US dollars. And you've got a pocket full of cash and you go to a car dealer and they've got a Ferrari, a Honda Accord and a Fiat 500. The Ferrari is 200,000, the Fiat 500 is 15,000. Now, being from Planet Zog, never having seen a car before, you should be able to evaluate that the Honda Accord price should fall somewhere between the price of the Ferrari and the Fiat. Okay? Because value is relative. You can only tell if something is good value by comparing it to something else. Okay? If you're going to buy a house, right, what's the value of that house? Okay? They figure the value of a house by looking at what similar houses in that area sold for recently. Okay? So whatever the method you use of assessing value, it has to be relative. Okay? And value in some way relates to correlated markets. So if the S&P 500 futures hasn't moved up a point, but the stocks and NASDAQ and the Dow are all screaming up, then for that moment in time, the S&P 500 is potentially good value. And on the contrary, if all markets have already moved up, and NASDAQ and the Dow and the stocks are starting to move down, but the S&P 500 is still at the highs, that's probably not a good value buy. Now, the other thing, and very important, is that traders accept the unknown and act on a limited set of information. Okay? And don't ever kid yourself you're acting on all the information. Because to trade index futures, you could worry about the individual stocks in that index, which is 500 for the S&P 500. You could worry about the impact of the options on those stocks and when they expire. You could worry about how index futures options might impact your trades, how currencies and interest rates impact your markets, because they do. You could worry about the way spreaders impact the market, even how oil and transportation costs make a difference economically. In fact, it's more than one person can understand or even comprehend. Economists pretend to, but they don't, right? The fact is, there's always going to be something affecting the market you trade that you're not taking into account. So you simply can't understand everything or weigh up all those factors at once to come to a decision. So you have to use just enough and accept that you can only look at a finite amount of things and just live with it. Okay? Because it's very rare to know without certainty that any particular trade will work. And as you add more things to take into account, you just make the decision-making process more complex, but you never get close to certainty. And the last thing, the penultimate thing, is they get in and they get out if they're wrong. Now, of course, professional traders have a huge commission advantage, which allows them to move more swiftly in and out of the markets, but having a larger commission isn't a good reason to stay in a bad trade. So probably the most important skill in trading is just getting out of a trade when you know you're wrong. Not when your stock gets hit, but when you know it will get hit. Okay? Because there's a really odd phenomenon in trading, and I've discussed this with a lot of traders, and it is very common. And that is, when you're not in a trade, it's tricky to really know which way the market's going. But when you are in a trade, when you have money on the line, it's much clearer whether your trade is good or not. And I've spent time, this is one of the things that kind of sends me half crazy. I've spent time going over trade videos trying to work this out. I know it's psychological in part, but most people I know can get a better read of the market when they're already in the trade. Like I say, I poured over trade videos trying to figure this out so I can bring that that post-trade reading ability to my pre-trade reading ability. But as yet, it's just something I've not been able to figure out. Okay, so knowing you're wrong and exiting a trade are, of course, two very different things. And many people suffer from that rabbit in the headlight syndrome and just freeze when a trade moves against them. Because I know I've done it, got into the market, it starts ticking against me, it tries over and over to get through my entry price, get up through my entry price and long, but just can't do it. And when that happens, the market's only going to hang around so long before other traders see it and push the market against you. So you see it happening, but you don't get out of the trade. And one of the reasons that we feel uncomfortable getting out of a trade sometimes is because once we exit a trade, as I said before, the market's going to go up or down. You don't have any control. When you get out of a trade, it just means you don't want to be in that trade again. The market goes up again afterwards and you are long, it doesn't matter. You did the right thing and you can't let that get to you. And finally, the other common element of success I've seen is traders remain constantly alert for changes in the pace of the market, because the markets change. We have rule changes, we have changes in volatility, we have economic changes, but even within a day, the market can change very quickly from slow to fast. And the strategy you need to apply for a directional market are the complete opposite for those who apply to directional range bound markets. So traders are constantly looking for areas where that transition might occur and the change in activity across the transition. And that's one of the biggest faults with setup based systems. They focus on setup and they don't focus on, is the market right for this setup? Okay, and that's the thing that gets overlooked in that kind of generic and simple cookie cutter system, but is absolutely crucial for long-term success. Now would be a good time to start typing any questions you have. Now, as I've said many times today, I don't think developing your own style is a choice you have to make. I think it's where you're going to end up if you're successful. Now, if you fight it and keep looking for other people's styles to emulate 100%, then you'll fall into the trap that keeps people in the learning stage for many years. And I know because I talk to these people all the time. And I know people have been trying to trade for 15 years and just haven't got it and still feel like they don't know the first thing about trading. So you have to take control of your education, whether you pay for it or find free sources. You have to make sure you aren't being pulled in too many directions or towards things that aren't properly explained or don't have a good logical reason behind them. And I think adopting your own style is something that people avoid because it sounds beyond reach when you start out. And so my goal today was really to try and take away some of that fear. And if I've planted a few seeds in a few heads today, I'll be quite happy with that. Now, in terms of how I trade, most of you know this. I have a few different techniques for different paces of markets. You all know it's all available free of charge on my website, Order Flow Foundation course, the link's there. It's not just used by retail traders. There's a number of proprietary trading firms using it as part of their intern programs. It might not suit you. It might not be for you. But if you're going to have a look at that, it's completely free. There might be a few things about the theoretical framework behind that style of analysis and the way we set trade locations that might help. And I say it's free of charge. Please do go and have a look. So Eddie, are you still awake?
Yeah, of course I am.
Hey, you're sharp, you are. I've got a little button here that sends a shock to Eddie to wake him up a couple of minutes ago. Do we have any questions, Eddie?
Yes. How can I disconnect that button?
Oh,
I hooked it up to what?
Unplug it, Eddie. Unplug it from the wall, mate. That'll do it.
Oh, brilliant.
Absolutely.
Now, we've got some questions here ready to go, and we're going to start up here. If you do have some questions, obviously post those in the Squawk Radio Room. We've got Fred's question here. Start out with Fred. Fred, great presentation. He says, Peter, do you believe traders cannot accelerate their learning because of the experience and screen time needed? We can only slow our progress down by taking an incorrect attitude towards education and improving ourselves. Thoughts on that?
I think basically if you treat trading as a skill, I'll give you an example. The guys that I meet a lot, because I'm in the order flow business, I'm not just trying to plug what I do, but I'm in order flow business, right? And I've seen stuff on the internet that says you need 10,000 hours to trade order flow. And I sit people down and I say, look, you're going to do this. You've got to do this, this, and this, and you're going to do it for 60 to 90 minutes, once or twice a day, and you're going to do 8 sessions. And once you've done those 8 sessions, you come back and talk to me, and it's like, I saw this, I saw this, I saw this, and we're talking about 8, 9, 10 hours work. So basically, I don't think it slows you down. Once you treat it as a skill, and once you understand what you've got to focus on, I think that's the fastest way. And I agree. I think it's the perception that the mechanical way, the non-skill approach, is faster. It's just a perception. If you actually sit down like a prop shop and focus on the right things, you'll start to see things really quickly. It's just a perception thing. It's like people go through 15 years, go through like 5,000 mechanical systems. That's not the fast way. But I think it's a valid point. I think it's just a perception that people do try and shortcut it by taking what is actually the longer route, basically.
All right, next question is from 603. 603 is asking, you mentioned money management and some people's beliefs that you can take random entries and be profitable with proper money management. Are you familiar with FT71 and his teachings on the subject using a coin flip? And what are your thoughts?
I don't buy it. I don't buy that. Think about it. There's HFT companies out there, right, that spend millions, hundreds of $1 million on infrastructure, right? Why aren't they tossing coins? Why bother? Why don't they just pay some guy $100 and get him tossing coins in a room? Okay, I mean, this is a competitive endeavor. Okay, so if people are out there trading their accounts, tossing coins, and beating everybody else at this game, well, my good luck to them. But like, I've never met a trader that trades off tossing a coin. Yeah, I mean, sure, if you want to sit down for an hour and toss coins and say, look, I made some money in an hour tossing a coin, that doesn't mean you're going to make money over time tossing a coin. So this is a competitive game. It's competitive. That's it. Bottom line, you're taking other people's money off them, and there's people putting hundreds of millions of dollars into HFT firms to try and scalp pennies off traders, right? They wouldn't do that if they could toss a coin, basically. That's my belief. That is my belief. Okay.
All right. Next question, 603 again. Peter, I've read that if you are correct about a trade, you should know it very quickly. Know it and know it almost immediately. And that great traders cover quickly when they are wrong. Can this lead to overtrading and dying by 1,000 cuts while you are learning?
Yes, absolutely. Because it does it takes a lot of experience. I mean, the guy I mentioned with the 85% win rate, he basically sat me, he's a market maker, and he sat me down and just showed me what he did. And I tried it for a while. I tried it just because I wanted to understand market making. And I would have died 1,000 cuts if I traded it live. But effectively, it's an experience thing. And in fact, it was funny because I did a webinar, and this guy emailed me after one of my webinars, and I was talking about this exact same thing. He's saying, you just got to cut trades that are going against you. And he wrote this long email saying, no, that's not right. That's what I started out doing, and I kept losing money, death of 1,000 cuts. And I said to him, look, I understand what you're saying, but it's just experience. Knowing when to get out is an experience thing, and it takes time to build that skill. And I explained to him what I did, and I got an email like 6 weeks later saying, you know what, I actually started doing what you're saying. You're absolutely right. So I absolutely agree. If I talked to a guy today he's doing a combine. He's having a pretty bad time of it, and his stops are too tight, and he's kind of not getting in at good prices, and he's doing exactly that. He's doing exactly that. It's the death of 1,000 cuts. You can't put 2 tick stops in the market. The time you can put like 2 to 4, 4 tick stop in the market is when you've got a fantastic price. So if you see the market at a price and you want to buy it, and you bid 5 prices below, yeah, absolutely, then you can have a small stop. But most of the time you just simply can't. So it's experience, and you're absolutely right. It can kill you at first, basically, but it's what makes people successful, or one of the elements anyway.
All right, Dante has a comment. Says, I'm trying to solidify belief in my orders by rehearsing what it will look like getting filled. Mm-hmm. While that helps me work some nice limit orders, I'm not getting filled, but I'm saving money. But I'm also not picking up enough ammo lately. Can you comment on this part of the trader's development briefly? Thank you.
Well, I think, I mean, when I hear traders say they're not getting filled, that's a really good thing to hear because it means you're trying to get a good price, right? And it just sounds like one of the dumbest things said, but honestly, trying to get a good price, I get lots of trades where I put, sometimes I'll put limit orders in, because I use order flow. There are times where there's a lot of times I tend to just go in at market because I wait for the order flow to show me. But if there's a price I believe in, I'll put a limit order in, and I'll actually wait for the market to come down and watch the order flow. And then if I don't like it, I'll cancel it. And a lot of the times I don't get a fill. And I think that's just one of the aspects of being a disciplined trader, and I think it's a good skill to have. If you get to a time where you're never getting a fill, and if that's been happening over the past couple of months, it's because of a reduction in volatility. And then you get to that part about understanding the market state and understanding the volatility's change. So yeah, I think if you're not getting filled on a lot of your orders, I think you're definitely onto a good thing, but you've got to make adjustments for volatility. Because the market's not going to pull back as much, now as it does, January, February, basically.
All right, 86 has a question here. I've noticed that I observe order flow better when I when in a trade also, but most people will say traders are less objective when they get in because hopes and desires take over. That happens to me also. Any comments on this?
Yeah, it's the difference between knowing you're right and getting out, or knowing you're wrong and getting out. Basically, I mean, you can see there, and you think it's not going. You can see, oh man, this isn't going my way. It's like the typical thing is you get into a trade, it ticks down immediately, and just keeps coming up to your entry price, and as if your entry price is a ceiling, comes down there, comes a bash, comes back, and just keeps hitting your entry price. Oh man, this is, at that point it's not going to go your way. And that's fine. That's that knowledge, or that's that feeling that it's not going your way. But then you can override that with, no, it'll go up. Then hope kicks in, and I think they're two different things. I think you intellectually know that it's not really going your way, but you hope it's going to come back. And what kills you is that thing of, probably half the time it's going to go your way anyway. If you get out of a trade, it's going to go up or down eventually, right? And the problem is, it does knock your confidence a little bit when you get out of trades because you think they're going against you, and it maybe goes against you another 3 or 4 ticks, and then turns around and goes back up. Okay, and that kind of gets you. But it's having that intellectual knowledge versus the hope that kind of interferes with your decision-making process.
All right, next question is from MetaTrader 20. I have a real problem holding on to winners. A good system with excellent discipline on stops and patience, getting into very good areas. But I have a constant battle holding for the original target, consistently jumping out too early. Any tips on this?
Well, there's nothing wrong with going for small trades as long as they're not, as long as your stop's not too far away. I mean, one of the biggest mistakes that a lot of traders get into is trying to get the whole day's range. But basically, I can tell you, I'm going to give you some advice that isn't my advice. So I'm going to credit John Grady with this advice, and this is what he tells people in this situation. Is you take an amount of money in an account, right? And I don't know, whatever it is, you take an amount of money, say it's like a couple of $1,000s, right? And you mentally write off that money. So you say, right, that couple of $1,000, I am now going to try and lose that money. And the way I'm going to try and lose that money is by never getting out of a trade early. I'm going to actually try and lose that money. And so basically what you do is, while you're trading that money, you simply stop behaving that way and say, so you're taking away getting out of the trade to try and get the profit. You're actually trying to lose this money, right? So you're basically trying to lose this money, so you don't get out of any of your trades early. You just put the order on, walk away, get out, move out of the way. And what you'll basically find, a lot of people that did this found that they actually made money doing that, made more money doing that, by just letting the trade work for them. So that's one way of doing it, and that seems like a really smart way of doing it to me, basically. Just set an amount aside and just write it off, and then just behave the way you think you should behave, but with the intention to lose that money. And that will stop you changing your behavior, because your behavior is changing right now because you want to book the profits. And if you try not to book the profits, you'll be able to trade the way you should trade. That's the theory anyway. I think it's a good idea. Just not mine.
All right. US 8lander has, I have used the OFA order flow software. How does your software differ?
Well, there's a few people that use both of them. Our stuff is basically kind of very short. So I mean, I don't know. What do I say? As is better. I mean, what do you say? They're two different products. I mean, OFA is kind of like footprint charts and kind of longer term order flow analysis. As is very much shorter term order flow analysis. Geared around the kind of stuff that that prop traders use, basically. I mean, it was all born from basically prop trading techniques. So it's just two different things. And we got people, I talk to DB from OFA from time to time because we have customers using both pieces of software. And, sometimes they've got a bug and we're not sure if it's them or me. So me and DB talk. So, two pieces of software. One's going to suit people more than the other, and some people use both.
All right, next question is from Ref Control Trend. I heard you say that you should trade with an eye on the correlated market. While I know you prefer the ES, do you happen to know what a correlated market is for crude?
That's a terrible question. You got Brent and WTI, which are the two main oil markets, but there are times when they'll diverge. Crude's a tricky one in terms of correlated markets. I mean, there are times when other commodities such as gold will move in lockstep with crude, and also the currencies. You'll see some inverse correlation with some of the currencies, but crude's probably the toughest one. Natural gas. But if you look at what spread traders are doing, you got like things like you might even not even have access to it, but like things like heating oil. There's a crack spread where they are trading the crude oil against the the broken down products like heating oil and gasoline. So they're things to watch. Natural gas and sometimes other commodities like gold, and then of course the currencies. But crude is probably one of the trickier markets to watch for correlations. It has to be said. Because there's a lot of movement on crude that's just like little one-lot trades all over the place. Not so much in the US session, but certainly in the Asian and London session. So sure, that's one of the tougher markets for correlations. And again, it's a market I don't really trade, so I'm no expert on it.
All right. Let's see here. Next question is from guest Peter. Would you say the average of successful traders you've worked with have a minimal mindset, keep their methods simple?
Yeah, I mean, the worst ones are pilots. Because the pilots come in, they want this big dashboard, they want like 500 dials on there. Yeah, most of them are just keep it simple. I think you can actually be too clever to trade. I think you can be too clever to trade. I mean, I think your ideal trader is what in England we call a Cockney barrow boy, which would be like a cheeky, all right, mate, how you doing? Oh, you want to buy this gold necklace? This kind of, one of those guys. They make really good traders. I think you can be too smart, try and know too much. I think with the prop guys, a lot of the advantages of the prop guys is they just take people from school that don't know anything about trading and don't have all their heads messed up with all this technical, mathematical stuff. But yeah, I think people who keep it fairly simple and just know when they're able to make a decision. Yeah, I mean, sure, the guy that I talked about earlier that was writing back, they're writing billion-dollar barrier options on US dollar, Singapore dollar. That guy, that guy was a nerd. That guy, had some brains behind him. But generally speaking, for the kind of stuff that we do, which is like trying to just buy when I want to buy it and it goes up and I want to sell it, I think you have to keep it fairly simple.
All right. Next question from Fred Decker. Peter, I agree with you about the experienced traders watching webinars and not adopting new strategies. But looking for a small edge, do you believe a trader's methodology should ever be changed, or does consistency overrule all other considerations? if we're frustrated with our pace of progress, when is changing methodology a good idea?
I think what happens is you evolve, and as you hear about things, they'll either fit in or they won't. You know, it's like, I don't know, it's like stickle bricks and Lego, which probably don't even exist anymore. I mean, it's either going to fit in or it isn't. There have been things that have simply stopped working for people. I mean, if you look at the floor traders, you know, what the floor traders used to do, they left the floor, and what they did it simply didn't work for them. And it's entirely possible that, you know, what I do now could for some reason in the future stop working and I have to start again. You know, the markets could be changed somehow. You know, legislation, if they brought in like in Europe, they were talking about bringing in like, I don't know, what was it, 1% or something financial trading tax. So 1% of the value of the trade on every trade, that would kill day trading effectively in Europe. So there are things, you know, external events that can change trading. But I think basically, from what I've seen, people, once they start making a profit, they will evolve. And if they learn about something new, it'll either be, yeah, that's nice, or, okay, that sounds interesting. I might be able to fit that in with what I do. But I don't see, you know, I've never seen people who felt the need to just reinvent themselves as traders.
All right, I think we got one more question here from Chu Barker.
That's a name. That's a great name.
All right, will Jigsaw reopen the training room?
Yeah, we will do at some point. I mean, it's just a matter of finding the right guy. I've got a guy now who's really good. Trade frequency is decent and very relaxed. So yeah, it will happen, but it's not something I'm going to force by putting the wrong guy in there. Basically, it's something we'll do, you know, once we've got the right person.
Okay, and I think that might be it. That might be it. All right. I think that's it. Any closing comments here, Peter? I know that you've got the website here, jigsawtrading.com. I will post that one more time. And if you'd like to, just click on the link. That'll take you right there.
No, just as usual, Eddie, Mike, the team, thank you very much for the invite, and thank you everybody for listening. And you know, just best of luck. It is a difficult endeavour for those who aren't there yet. It's just best of luck with it, and keep your head screwed on. You know, don't fall for the blonde and the Ferrari.
Hard work pays off for the blonde and the Ferrari and the guy with six packs, whatever.
Yeah, you go to all those different websites. It's the same blonde.
Well, everybody I guess is reaching first, not taking it. But all right. Let me see here, just real quick here. You're getting excellent presentation.
Thank you, guys.
Very much. Good presentation. Great. Thank you, Peter. So once again, Peter, we appreciate you coming on here, and thank you for taking the time to do this presentation. Like I said, I was really pleased with the article that you had, and I thought it was very informative, and I'm glad that we put it in a webinar format. You put it in a webinar format.
Your idea, though, Eddie. Your idea.
I handed you the ball, and you ran the 100 yards.
Absolutely.
So, but Peter, appreciate the time here. Once again, thank you for everyone that did participate and everybody that did join the webinar. And Peter, have a great weekend, and we'll catch you back here next week, which we do have Peter on every Tuesday and Thursday at 9:35 Central. And best to you, buddy.
Okay, thanks, Eddie, and everyone have a good weekend.
All right, thank you, sir. Take care.
Bye.
All right, there's the link. Once again, it's jigsawtrading.com. And if you are new here and you're not too familiar with Peter, every day has a pre-market ES blog. So S&P Minis, it's posted in Big Mike's. We also post it here in our blog. So remember, the Squawk Radio Room is free here. And if you'd like to join us, by all means, it's open 24/7, and we do the broadcast from bell to bell. I get here earlier. But if you'd like any other information, get a hold of Peter at jigsawtrading.com, and you can go from there.